Warren Buffett once said, "Time is the best friend of a great business and the worst enemy of a mediocre one." And Palantir Technologies, a company often polarizing among investors, seems to bring this quote to life. Today, I'll address a question that might cross the minds of any investor riding the waves of market trends. Is Palantir my biggest letdown or the beginning of an incredible journey? Look around, and you'll notice a mass exodus from growth stocks. The same people who praised story-driven investments over fundamentals now seem to be sprinting in the opposite direction, convinced that value stocks are the only way forward. Yet, ironically, leading the charge is none other than Jim Cramer, who tends to pivot his opinions with the market winds, like a weather vane in a storm. So, here's the real question for Palantir's future: should it be lumped with the growth stocks that investors are abandoning? And if we answer that correctly, could it mean a golden opportunity for those paying attention? Let's look at what truly sets Palantir apart from the typical high-flying, high-risk growth stocks. Many growth companies are overloaded with debt, struggling to show profits, and, frankly, rely heavily on their story rather than actual financial health. They burn through cash with little revenue to support themselves, a combination that makes them especially vulnerable in an environment of high interest and inflation. Now, what if I told you Palantir doesn't belong in this group? Here's why. Palantir boasts zero debt on its books, a rarity for a growth company. And while so many are feeling the squeeze from rising interest rates, Palantir sits on a $2.5 billion cash reserve, giving it the power to weather financial storms without taking on additional burdens. This cash, combined with its strong fundamentals, allows Palantir to maintain operations without leaning on debt or leverage. Not only that, but the company is expected to close the year with around $1.5 billion in revenue and $400 million in free cash flow, with consistent operational profitability in recent quarters. People seem to misunderstand that Palantir's stock-based compensation, which impacts reported profits, is purely an accounting item. It doesn't impact cash flow, which is what truly matters when gauging a company's financial strength. Palantir has proven its resilience in a market filled with highly leveraged and cash-strapped competitors, yet the stock still seems to be dismissed as another risky, overhyped play. What's even more compelling about Palantir is its clientele. This company doesn't cater to just any customer, it serves some of the wealthiest clients worldwide, including governments and Fortune 500 companies. These clients can absorb price hikes due to inflation without batting an eye, which means Palantir can adjust its prices as needed without losing business. Unlike other companies that would need substantial capital investment to scale, Palantir's software as a service (SaaS) model allows it to increase service output without significant capex. But, despite Palantir's rock-solid fundamentals, the stock still lags in market performance. The company had a standout year, yet the stock trades like an embarrassing afterthought, dismissed by mainstream opinion. For savvy investors, this disconnect could be an opportunity to buy in before the crowd catches on. With an 80% gross margin, Palantir is priced to capture enormous upside potential as the market recognizes its value. We're seeing short sellers pile on, driving Palantir's short interest from 3% to over 6% in recent weeks. This increase is putting pressure on the stock price, but here's the catch: if the company continues to perform well, that short interest could eventually trigger a rapid price surge as shorts are forced to cover. And with Palantir trading at a price-to-sales ratio of around 19, yet still undervalued by at least 70% on the most bearish of models, the setup for a rebound seems ripe. Now, let's paint the picture of Palantir's future. Even if interest rates rise and growth slows to 30% annually, Palantir could still be valued at nearly $50 billion. But this isn't just wishful thinking. Palantir's management has stopped selling shares, stock-based compensation is down, and margins are on the rise. Every indicator points to a solid growth trajectory. So, why is the market ignoring it? Could it be missing out on one of the most promising tech plays simply because the stock doesn't fit the conventional mold of growth or value? Maybe. But, for those with patience, this might just be the moment to sit back with a warm cup of tea and let time do its work. Because, as Warren Buffett might say, time could reveal Palantir to be more than just another growth stock. It could be the gem in a market of mediocrity. Like, comment, and subscribe if you want more insights on opportunities the mainstream might be sleeping on. Let's keep the conversation going.